Let's get more on the markets. We're joined by Colin Stewart, CEO and Portfolio Manager at JC Clark. Colin, thanks very much for coming on the show. We have seen a bit of weakness today in US stocks and apparently trade contributing to that.
Yeah, Andy, nice to be with you. And I think the volley we saw from China last week on rare earths and the U.S. administration's threat late last week to put 100% tariffs on Chinese goods. I mean, sort of another flare up of the trade tensions between the U.S. and China. And obviously, China is a huge trading partner, so that's a concern to the markets. And I think there's a lot of things going on. I mean, we have the economy showing some signs of weakening here in North America, both in Canada and the U.S. The labor market's been a little bit weaker recently in the U.S. And, I think one of the things we're really watching closely, and as I think other investors are, as we move into Q3 earnings, are, how are these tariffs actually are flowing through into corporate results? I mean, when we saw the last quarter reported, it was pretty early days, and we hadn't seen a very long period of these tariffs in place. And now with sort of a full quarter with a lot of different businesses having to deal with U.S. tariffs, it's not entirely clear how that's going to impact various margins, earnings, and I think even demand levels. And it's been our view, and still is, that someone really has to pay for these tariffs. And despite what Trump may say, that it's all going to be foreigners paying for that, we think certainly some U.S. companies and the U.S. consumer are going to have to bear some of the brunt of those tariffs. And perhaps we're seeing that start to seep into some of the economic data we've seen more recently, which has shown, as I said, a little bit of weakening.
Yeah, so Trump going after the big Chinese shipping companies, including Costco and Orient Overseas, the huge container shipping companies, and they face billions of dollars in extra port levies.
Yeah, exactly. And I mean, I think at the end of the day, it's always been our view, and I think economic, history would back that up, that trade barriers and tariffs are not really productive for the global economy. And well, certainly I know there's a method to the madness, and the idea of bringing jobs and investment back to the U.S. And we've certainly seen some of that. It's just, this idea that it's all going to be borne by foreign companies, I think, is just a false narrative. And, ultimately, it's going to be some combination of foreign manufacturers, the overall supply chain, and then U.S. consumers. And either that's going to lead to potentially higher prices and a resurgence in inflation, or maybe even more likely just a weakness in demand. And you've already seen some of the, even the very largest companies in the U.S. that have presumably the most bargaining power, like a Walmart or a Home Depot, suggest they are going to have to, in certain instances with certain products, pass along price increases to consumers. And I think it's going to be very interesting when we see earnings reported this quarter, how that's impacting margins, how that's impacting consumer demand for certain products. And again, with the U.S. stock market at record valuations, we're a little bit cautious and think now is the time for investors to be, a little bit defensive given where valuation multiples are.
Maybe we could put up a 5-year comparative chart for the TSX Composite and the S&P 500, because if you exclude dividends, and I'm looking here just in US dollars for both indices, the American market is up about 90% excluding dividends in 5 years, almost a double. Our market's up about 72%. However, because our market is more rich in dividends, we have actually caught up with the American market over 5 years and actually exceeded it. Our market's been, we're level pretty well. Both markets are double in the past 5 years, if you include dividends. So we've caught up with the American market in the past half decade. And again, that is, according to my Bloomberg screen, all in US dollars.
Yeah, and that's obviously partly due to the fact that the Canadian market has been very strong this year. Part of that has been led by commodities and gold, as we know. But I think despite the fact that the Canadian market has outperformed this year, it's our view that the valuation multiples available and relative value of the two markets, the Canadian equity still traded a much lower price to earnings multiple than the U.S. equity market, and I think that suggests there's a higher margin of safety here for investors. And as you suggest, Andy, even, many attractive dividend paying stocks. And in this type of environment with a great deal of uncertainty, geopolitical tensions, the prospect of inflation still staying high, a weakening economy, and really uncertainty as to how this tariff war is going to play out. I think it, in our view, and where we've been focusing for our clients, is really on dividend paying equities and on some of the, sectors in the Canadian market that we think are a bit defensive. And I think that's, really a better place to be. And if things do correct at some point here, we've seen, obviously saw some volatility in the market on Friday, and if today again in the U.S. market, and if that continues, I think the Canadian equities could be a sort of a better place for investors to position in the near term, for the various factors I outlined.
One sector that's catching your eye right now, Colin, is real estate. Is that in Canada?
Yeah, exactly. I mean, I think there's real estate has been out of favor for a while in both Canada and the U.S., and that's partly due to the fact that we've had interest rates moving up for the last few years, albeit it now appears that interest rates have started to come down. And as everyone knows, I mean, I think lower rates are generally good for real estate. It's good for bringing cap rates down and expanding valuations. It's good for the real estate companies being able to refinance their debt at more attractive levels. And so, it's again one of the sectors that has not, performed all that well. And we've seen, some better performance in some of the Canadian real estate names this year. But yeah, we think there are a handful of areas in that market, whether it be, apartment companies that own land, self-storage. Another area we like, a company called Storage Vault is one of our favorite names in the real estate space in Canada. And all of these companies are, I think, poised to benefit from longer term population growth in Canada and from lower interest rates as well.
Colin, thank you very much indeed.